Welcome to Video20C on partnership accounting methods. So as we discussed in Module 1, you can look at a partnership at both an aggregate and an entity level. And at the entity level, the partnership itself makes a number of tax elections. For example, the overall accounting method, cash versus accrual. The election to expense a portion of the organization and startup costs, like we covered in Chapter 10. An election to expense tangible personal property under Section 179. The bonus election out of treatment if the partnership wants to do that. So at the partnership level, most tax elections are made. From an accounting method perspective, partnerships are generally eligible to use the cash method unless they have average gross receipts greater than that magic 25 million we talked about back in Chapter 9, starting in 2018, and have corporate partners. They can have well in excess of 25 million of gross receipts if they have no corporate partners and still use the cash method. So partnerships do have some flexibility in choosing what year end they want. So for example, let's say that the partnership year end is January 31st and the partners are all individuals, which means their year end is all December 31st. And let's say this partnership earns income of $100,000 starting in the fiscal year February 1st, 2018 and ending on January 31st, 2019. So you can see that what happens is because the partner picks up the income as of the partnership year end, then the partner would not pick up any income until 2019, even though 11 months of that income was earned in 2018. And the book provides a graphical depiction of such a deferral. So this would be the maximum amount of deferral you could ever arrange for with a bunch of individual partners. So as you can imagine, the rules do not permit such a deferral. And instead, partnerships are left with three choices. Choice number one is to use the majority interest taxable year. So for example, if one or more partners with the same year end own more than 50%, if they're individuals, for example, that's probably December 31st. Therefore, the year end has to be December 31st. If there are not one or more partners with the same year end owning more than 50%, then you look at the principal partner year ends. So if there are partners with a 5% or greater interest and have a common year end, then you must choose that common year end. And then lastly, if neither of those can apply, you pick the year end with the least aggregate deferral. And I'm not going to make you prepare a least aggregate deferral calculation on your exams, but you can certainly see one in the book. Okay, so here's a great table you use that you can follow through to see what a partnership year end is. And speaking of end, that brings us to the end of Video20C. Thanks for watching.
Oh!